All right, so a few months back, maybe 3, 4 months back, I made a video on a mock $1 million portfolio that a lot of YouTubers were doing. I wanted to kind of throw my hat in the ring and give one, just for fun, essentially. Obviously, I don't have $1 million to invest. If I did, I probably would be in a little different situation. So let's get right into it, and I'll kind of go over all the positions briefly, say what I would change or how happy I am. The first one, and again, I believe these are in alphabetical order, so they are in no particular order. AGM, Federal Agriculture Management. This one's ran like 20-25% since I've made that. So again, very happy with this one. I think this one's a home run. I definitely still would have it. I wouldn't even think twice about it. I think it's definitely bordering on a little more expensive right now, but still a very good company. Very happy with that position. ARE, Alexandria Real Estate. This one's almost exactly where it is. Although, again, it does have a 4.5% dividend, which I believe they're growing about 5-6% a year. I still for sure would keep this, definitely, because I think it's a good area, and even though it hasn't necessarily grown a lot since then, again, it's only 3 months. That's peanuts in the long run. I still think the fundamentals are good on it, so I definitely wouldn't change anything there. Alimentation, Couche-Tard, ATD.to. This one's up maybe 6-7% since I made that. Again, very, very solid company. Definitely would not change this one. This is one that, honestly, it probably, if I had to pick 5 companies to hold for the next 20 or 30 years, it almost certainly would be in there. So definitely would not change that position. American Express. This one, I believe, is down a little bit. Honestly, I'm not sure off the top of my head. I believe it is down a little bit since then. I honestly, of all the ones in there, this is one of the more likely ones I would switch out. Not that it's not a good company. And the reason I picked American Express is they have a very good brand. They have a very good moat, I'd say, over the next 10 years, maybe 20 years. Anyone that has a credit card, the amount of people that I come across that just love their American Express because they have such good points, their point system and stuff is definitely the best. And not only that, there's a lot of other stuff that goes with it as well. And again, this is in Canada. This isn't even in the States, right? So again, I think it's a very good company. The dividend growth is solid. I still like it. Again, I don't think you're going to see crazy growth, but again, a company I still think that very, very surprised if it doesn't at least do reasonably well. Canadian National Railway. This is a company that, again, it definitely has trailed the market. I don't know if it's up or not ever since I made the video. This one, again, I don't think it's necessarily going to perform amazingly well. But again, this is a company that has very, very good moats. I mean, basically, it's impossible to compete with them and CP. And again, I think it's just going to become a dividend company over time, right? They're growing it fairly nicely. I think it's around 2%. If they grow that, 8% a year for the next 30 years, I would be okay with that. And again, I don't think that the demand for their product is necessarily going to go down over time, right? And I think it also provides a good form of diversification, right? In that it's a separate, it's in the industrial sector, right? So that's why I like CN. I would keep it in there still. Capital Power is the next one. This one is down, I think maybe 10% roughly since I made the video. In fact, of all the ones, this might be the one that's the most down. Actually, there's one other one I think that would be more. I still probably would keep it, but number one, because it's a utility. Number two, again, it's got like a 5.5% dividend, I think, where it's at, and they're growing it like 5-6% a year. Again, you're not going to see crazy growth, but again, if you have a 5.5% dividend that they're growing 5-6-7% a year, I don't think I would be concerned about that over the long run. The next one is EQB.
AGM,
EQB is up, I think, about 15% since I made this.
Again, really like that company. It's more of a dividend growth company.
Absolutely love the company.
Alexandria
again,
Real
I don't
Estate,
think you're necessarily going to see crazy growth.
Concept, more of a life sciences REIT, which
definitely
again is
still a company that I for sure would not think twice about keeping. Right? Again, you got. I think it's. I don't even know if it's a 2% dividend where it is right now, but you also have to keep in mind they're growing that like 20% a year, which is just insane. The next one is EQIX. This is a data center REIT. This one's gone up a lot over the last year. I definitely would still keep it because I think it provides a good form of diversification. I think it's a very good company. I think it's an area that for sure is going to see growth over the long run. So that's why I would keep that. The next one is Extra Space Storage. Of all the ones in there, I believe this is the one that's down the most. They took over LSI. They're down. I think they're down to like they're the high 120s, so they're down maybe 15% roughly since I made this. I still like the area. I think it provides a good form of diversification. So again, I definitely still would keep this company. Although it is definitely disappointing that it's down pretty significantly since I made it. But again, short-term price fluctuations I could care less about. The next one, Go Easy. Again, this is one that I think isn't a 100% home run, but I think it's good. It's up. I think it's around 120. So again, you're up roughly 10% since I made the video. Again, very nice dividend. I think you got like a 2.5% dividend. They're growing that like 25% a year. Definitely would keep this company. The next one, IIPR. This is one that's been one of the bigger home runs. It's up around 87, I think, right now. So again, you're up maybe 25% since I made this video. And again, on top of that, my yield on cost, I believe, is over 10%, right? So that's why, again, I definitely would be keeping this company. The next one is Kroger. I probably honestly would swap this one out. Not that it's not a good company. I think there probably is better opportunities. This one's definitely underperformed the market recently and over the last year or so. Again, it's a solid company. You got like a 2% dividend. They're growing that pretty nice. I still think it's a company that, again, the demand will stay. They're a good company. Good, not great, I think is a better way of putting it. And I don't think it's going to necessarily outperform. That's my one critique of it. Not that it's not good. My point would be that I think that you can find better opportunities. I guess is a better way of putting it. The next one is Microchip Technology. This one's up, I think, a tiny bit since I got it. But again, you got very nice dividend growth. I think you're around 2% was my yield on cost. They're growing that very nicely. This company's always outperformed the market. Is that always going to happen? Not necessarily. But again, very, very, very good company. I would be shocked if this company doesn't outperform the market over the next 10 or 20 years. The next one, Old Dominion Freight Line. This company, I think I'm up like 30-40% on this position. I think of all the ones in this mock portfolio, this is the one that I'm up the most. And I definitely still would be keeping this company. Again, crazy good dividend growth. I think the actual dividend's only like 30 basis points or something like that right now. But again, it's growing like 30% per year. Definitely still would be keeping this company, although it is expensive where it's at right now. So you're going to have to wait for a pullback to get a position on this company if you do want to develop a position. The next one is Universal Display. I'm up a little bit on this company, but again, very nice dividend growth. I think this company has a very good moat, very good company, no debt. The demand for their product is not going anywhere. In fact, I think it's going to go up over time. So again, I still really like that company. Definitely would be keeping it in there. The next one is Qualys. I'm not sure if that's how you pronounce that. QLYS. This one I'm up probably 25% on. Again, definitely still would be keeping this company. That one's an absolute home run, A+ in my point of view. And it is probably about fair value where it's at right now, maybe a tiny bit over. The next one is Steel Dynamics. I think I'm up a little bit on this one. Definitely still would be keeping this one. This one's like a B+, I think. Visa, I'm up about maybe 10-15%. Again, absolutely for sure still would be keeping Visa. I think it's an amazing company that did extremely profitable, nice dividend growth. I think this is a company that, 10-20 years from now, it's going to be a more of a dividend play to where you're not going to get crazy price returns. But again, I think they're growing their dividend like 17% per year or something like that. That means you're doubling it every, that would be roughly doubling every 4 years, right? So, that means your dividend's going to be 5x what it is right now, roughly 20 years from now. So, again, their dividend's about 0.8%. So again, you're looking at what, like a 3.5-4% dividend 20 years from now. I think that's a home run if you ask me. Vici Properties, I believe it's down slightly since I made it, but again, it's got like a 5% dividend. They're growing that nicely. The demand for their product is going to increase over time. Again, I think it's a B plus, maybe an A minus. And the last one, Waste Management. Again, Waste Management's one of those companies that I think is a must for a portfolio, not because you're going to get crazy price returns, but again, solid dividend growth. But again, the fact that it's non-cyclical, like again, the demand for cleaning up trash does not go anywhere during a recession. It stays there, right? So because of that, the company does trade at a premium sometimes. So you definitely want to keep an eye on the valuation if you are going to buy. But I think this is a must for any portfolio. But again, it's one of those companies, again, you're not going to see crazy good price returns. So just briefly going over it again here, let's check and see which ones, the ones I would switch out. American Express is definitely one I probably would. CN I would keep in even though it's underperformed. Extra Space Storage I would keep in even though it's underperformed. I might consider an alternative there, but I think I would keep it in. Kroger I would swap out. So that's two. What else? I mean that's really it. Like that's really it. They're like I say. So 2 out of the 18 are ones that I probably would swap out. And they're by no means are they has anything crazy changed. The reason that I would swap those out is not because they're bad companies. My thesis on those companies has not really changed, maybe slightly. But the reason that I would swap it out looking back is I think that there's better opportunities, not necessarily that they're bad companies, right? So again, that's another thing you really want to look out for. And again, this is the last kind of somewhat unrelated topic I'll touch on, is that you want to keep an eye when you're, at least in my opinion, I mean, people might disagree with this, but whatever, I'm just going to say it, because there's a lot of YouTubers out there that if you look at the stocks that they've touted, like if you follow these guys for 3, 4, 5 years, whatever, look back at some of the stocks that they used to be touting, and a lot of these guys have pushed just absolute garbage, like absolute garbage. I mean, there's one guy in particular, just push. I think he has several channels actually, but there's one that's got, I think, bordering on 1 million subscribers. Last I checked, I think it's a little bit below. But again, just push, just absolute garbage. I mean, I think he kind of made his name by being bullish on Tesla for 10 years ago. But other than that, there's a lot of just absolute garbage. And I think that that's something you really want to look out for, is that do these YouTubers have this shiny object syndrome to where they're constantly changing their mind about everything? And I mean, I think that that's something that's pretty undeniable to be a successful investor. It's like you can't have shiny objects syndrome. You can't constantly be chasing this stock and that stock and this stock and that stock. And it's like, just, and again, this is what, virtually every expert will also say. It's like you want to have maybe 30, 40 positions, maybe at the most 50, right? And I think that's something that's very important. And you also want to keep an eye on what are people's highest conviction plays, right? And I mean, looking back on it, my highest conviction plays were Old Dominion, Go Easy, IIPR. Not necessarily, I think, as far as the risk versus reward, that's what I really like there. Visa has always been a high conviction play for me. EQB, QLYS. What are some other ones here? Basically, I mean, a lot of the ones in here, right? ATD, definitely, like I mentioned. AGM, I think, is one that I really like. EQX, I think, bordering on that. I think that's more of a second tier for me. But again, microchip technology is definitely in there. So again, those are my highest conviction plays, right? And again, every single one of those has done well. Now again, we are looking at a short period of time, but I mean, if you look at the fundamentals on every single one of those, nothing really has changed. So anyway, that's what I wanted to bring up today. I will periodically, check on this, and honestly, I might even swap out positions because I know some of the guys have swapped them out. So I might look into doing that and seeing how that goes. But again, that's a video for a different time. So if you like the video, hit that like and subscribe, and stay tuned for more.